Chris, thank you very much for joining us today. You and I both listened to the John Rubino discussion, and I just want to get your thoughts on a lot of the things you said about the U.S. economy and also equity valuations and what you're proposing your clients do during these uncertain times. And why don't we just start with the U.S. economy? John expressed a lot of concerns with the economy. What do you and your team think of the U.S. economy right now as it stands?
Yeah, well, first of all, I'd have to say that I've listened to a lot of John Rubino over the years. I definitely like what he has to say. I generally probably agreed with the vast majority of what he just said. We are likewise concerned about the economy, maybe for different reasons. A lot of people focus on what I would call, the sparks that so-called create a recession. When in reality, it's kind of like a forest fire. Like everyone's focused on did this campsite start or that campsite. In reality, you should be looking at the conditions. It was dry, it was windy, there was too much undergrowth. That's really what's you should be looking at. And for us, the analogy would be that's what year over year money supply represents. That's what the inverted yield curve represents. That's what credit spreads represent. And if you look at that kind of data, I'd say 2 out of 3 have been flashing red signals, and they've been flashing red signals for about 2 years now, really since late 2022, so just over 2.5 years. So we are definitely concerned. Now, the question would be, well, what could spark it this time? And really anything could. My personal theory would be that we could have an impasse at the budget here. I know we just passed continuing resolution, but I think we will have what I would call a gilt crisis in the U.S. So you may recall in October 2022, in the United Kingdom, their government bond, 10-year government bond known as the gilt, they passed a new budget or proposed a new budget. And that yield on that 10-year went from like 3.3 to 4.5 in 2 days, right? It dramatically increased interest rates because everyone was concerned this new budget, they could never pay down the debt. Well, we may be entering that right now with the U.S. I thought we had a real chance here to cut back government spending, and instead we passed another continuing resolution. Despite all the progress Doge has made, et cetera, the reality is without congressional approval and congressional changes, no real change is going to take place. So I am concerned about a recession. I have been concerned about recession for some time based on the factors I just mentioned. But I think the probability as time goes on increases. So I think if anything, people should be more and more cautious, not less.
And to your point, people have been talking about a recession now for quite a few years, and it hasn't come. It just keeps, the economy's doing okay. The U.S. GDP is growing at around 3%. The unemployment rate is staying relatively low at 4%, give or take. But what concerns you when you look at when you dive deep down on the U.S. economy? What elements really stand out to you that give you concern about how the U.S. economy is doing and where it's going?
Well, there's probably a whole bunch of different factors. If I was president or part of the administration, there's a whole host of things, reforms I would have enacted. But for me, the biggest issue will be, and probably will be for the next 10 years, unfortunately, the overall fiscal situation. I mean, money supply growth has been, it's low single digits. So that's not portending necessarily anything dire immediately. It's not, neither is it portending anything or predicting anything that's really beneficial for the markets. But for me, ultimately, it comes down to the budget and it's what it does to the overall debt levels, because there's no way the U.S. government can ever pay this debt down, right? This is just impossible without inflating the currency. So I really think that's what everyone should be laser focused on, the debt and actions to reduce the debt. And if no action is taken or things get worse over the next year or so, then all bets are off, because frankly, Trump and this administration has the most power right now, because a year from now, you already have razor thin majority in the House. Every congressman there starts looking at their reelection, right? That's all they're thinking about. So if you're going to do anything, it should have been now. And I'm afraid if you don't do it 6 months from now, when they run out of money with the latest continuing resolution, that's when we could very well see a crisis develop, if not sooner.
Interesting point. And we do have the midterms coming up in 2 years. So there is a lot of commentary about this recently. And a lot of people are thinking the current administration is trying to push this economy into a recession, get the pain over with relatively quickly, and then get ready for 2026. Do you think they're actually trying to orchestrate that?
I don't know. It's quite possible. I mean, people would say that Reagan did that when he passed his tax cuts back in 1981. They would argue that he couldn't have done that without kind of the double dip recession that was experienced right then. I don't know if that's really part of the playbook by the administration. It could just be that they think it's a high likelihood that this could happen. I mean, they have a very good Secretary of Treasury, unlike his predecessor. So that would not surprise me if they thought it was coming and they're just trying to politically position themselves accordingly. That's, I think, more likely than any kind of planned recession where they think they could do something with it.
And you touched on the debt levels a couple of times. So it currently stands around 36 or $37 trillion, just a mind-boggling number. The interest payments are well over $1 trillion now to service that debt. And the debt to, or the deficit as a percentage of GDP is around 7% right now. And the current administration wants to get it down to 3%. Do you think that's possible in the next 4 years?
I don't. If you asked me this 2 months ago, I said it was highly more likely than I do now. By the way, I'm not sure why the target's 3%. I'm not sure why it's not zero, because zero gets you, you're not making things worse. You're not really making things better at three, right? Better than what they could be at seven, but it's not diminishing the overall debt levels in any capacity. So, do they get there in 4 years? I highly doubt it. And this is based on, I mean, the second time Trump's been president. Yes, he's much better prepared this time. Yes, I love what he's doing. He's doing it far faster than what he did before. However, he never really touched the budget. He was on, when he was on Joe Rogan, he said if it wasn't for COVID, they would have balanced the budget that year. I mean, that's just wasn't possible. It's not feasible, and that wasn't going to happen. But I'd be surprised if they're south of 5% in 4 years. And frankly, if we have a recession, which could be a prolonged and fairly severe recession, it could be far worse.
So let's talk about equity valuations now. And this is something else John talked on. He thinks we're going to get a pullback in the economy, which will lead to a recession and also a bursting of the bubble that we're looking at right now in the S&P and the NASDAQ. And he actually said he thinks the S&P can pull back. I think the numbers he threw out was 50 to 80%. And he's comparing that to what we saw in the early 2000s when we had the tech bubble. What are your thoughts on equity valuations? Do you think we're going to get a significant pullback? Right now, the S&Ps are down around 10% on the year or from its peak. What are you looking for in terms of a pullback here in the S&P and the NASDAQ?
Well, as far as the worst thing in the world for equities would be any kind of economic weakness, whether it's a recession or otherwise, or rising interest rates, right? Slow growth and rising interest rates are a recipe for contracted PE multiples, or any kind of, really, for that matter, valuation multiple. So he's right on point. That could very well happen. Now, it's a little bit different when you're actually managing people's money and you have to prepare for it versus just speculating what could happen. So, I mean, everyone should be defensive. Everyone should have high cash positions. Everyone should think about what gets hurt in a recession the most, as far as like cyclical stocks, et cetera, anything with high valuations. That's how really people should be positioning themselves going forward. As far as what happens with the S&P and NASDAQ, I don't know exactly, but I mean, we've seen this happen before. It's not ancient history, right? We're not talking about the Great Depression, although that's not off limits. We could talk about what happened then, but you just got to look back in the last 25 years, and we've seen this happen before. Yes, there could be a huge downturn in equities. I'm not saying there will be, but if the conditions are right, that absolutely could happen.
And John was very bullish on gold. Do you and your team have a view on gold?
Well, we've been bullish on gold for a while. I'd say we are still so-called bullish. Um, Gold's not cheap at this level. It is, but I think everyone. So instead of everyone piling in right now and establishing, large positions, I would phrase it more so: if you don't own gold, you should consider owning gold. If you do own gold, I don't think I'd be a seller at these levels. I like, just based on purely the solvency crisis, which I think eventually happens for the U.S. It's prudent and proper for investors to consider fairly large precious metal positions, gold or silver. So I like gold. At gold at 3,000, I like to obviously much more at 2. But frankly, gold could easily be above 5,000 an ounce if we have a major solvency crisis here. That's certainly not unreasonable by any means, and it could happen quickly because we just saw gold go up by a third in just over a year, right? So it doesn't take a lot to push it up to 5 right now.
And to your point, you always have to, when you're a money manager, you always have to have an allocation toward the equity markets, but you can reduce it. Have you reduced that exposure to the S&P, and have you increased your weighting in cash or cash equivalents?
Yeah, we've been pretty defensive for a while, concerned about the markets. That doesn't mean we're not buying things. There's always rotation, there's always opportunities. So it doesn't mean we're stagnant or not doing things. We're just out of the market. That's actually probably a big problem psychologically for a lot of people because it's very easy just to get out of the market completely, right? It's like a cave bunker mentality when you're in there and you've got golden bullets. That's fine in dire situations, but the reality is life gets in the way. People have retirement, they have goals, they have objectives. You just can't do that completely. So I'd say overall we're very defensive, but that doesn't mean it's like a bunker type mentality.
Well, Chris, that was a great discussion. And I want to thank you for providing your feedback on John Rubino's conversation. And if somebody would like to learn more about you and your team and also Winrock, where can they go?
Yeah, well, I'd say we post all of our past research, all of our post podcasts. Obviously, we're on Wealthion frequently, so you can go to that website and just kind of search our names, and a bunch of videos will come up. We also have everything on our website, which is windrockwealth.com, and we push everything out via X, which is at Windrock Wealth. So feel free to check us out there.
Chris, once again, thank you.
Thank you, Jimmy.